Apex is a Windows-based application produced by Venturing Engineering Incorporated in conjunction with Infomine USA Incorporated, designed to evaluate and assess the economic potential or economic viability of proposed mineral development projects. The program, in essence, takes cost, revenue, and production data for a specific project and determines net present values, internal rate of returns. Can be used to determine break-even points. You can run sensitivity analyses, and you can do risk assessments, Monte Carlo style risk assessments. The program presents as 4 separate screens, 4 separate data menus. One is for data entry, one is for analyses, one displays schedules, and the final is utilities menu. These menus are always on the screen, and that way users are able to find which specific entry screen they're looking for at any time. The best way to demonstrate the program is, of course, to run through a quick example. So we'll enter our information on the screen: commodity information, mining and processing, cost and production data, smelting information, capital costs, and we'll look at financing, royalties, and taxes and escalation. Let's enter some commodity data. We'll say we have a small gold-silver project. So we'll enter our information for our gold. Data entry is usually limited to either entries you can type in text form, entries you can select from an option box, like that. Or you can also enter values, which we'll get to in a moment. Each entry has a help screen associated with it, so if you don't know the proper entry, it will either provide information as to specifically what you might enter, or give you some information on what the cell is looking for. In this case, we're looking for the depletion rate of gold and silver, which is 15%. Select that from our option box, and we'll say our project is using tons as the reserve units. So we add that into the project, and now we'll start entering values. For gold, we'll say the grade is 0.07 ounces per ton, and let's say that any wall rock or dilution waste that is recovered along with the ore carries a little bit of gold as well, in this case 0.007 ounces per ton. Let's add silver to the analyses. Again, the units will be ounces per ton. Prices will enter in dollars per troy ounce. The depletion rate again is 15%. Let's say our silver grade is 1.4 ounces per ton. Any silver included in waste would be at a grade of 0.14 ounces per ton. On this screen, I want to point out the set designations. This is a powerful tool that the program has that we won't get into too much during this example, but you can enter a variety of sets with this that can be associated to different grades. For instance, if you have different areas of the pit or an underground deposit that have different grades, each one can be handled separately, or if you have feed from several deposits coming in, each can have its own grade set. If you have different royalty partners, royalty streams, you can enter those separately. You can have a variety of different processing sets, meaning you could have more than one processing plant, perhaps a heap leach and a CIL at one project. And you can have a number of mining sets, which are based on this screen, which means you can have feed coming in from different properties into one analysis. For this set, for this particular project, we'll say production begins in year 3. Say we have 22.4 million tons of reserves. we'll recover 90% of those. And we'll say we'll inadvertently take about 10% waste during our mining process. We'll produce at a rate of 1,200 tons per day. And our mining cost we'll enter at about $40 per ton. Notice we could also enter our mining cost in terms of tons per day, or excuse me, dollars per day. We could enter a waste cost along with a stripping ratio if that cost to mine the waste was different than the cost for the ore. We could also break these down into categories of labor, supply, and equipment if we wanted to escalate those separately. We'll go on to processing. We already have our production rate of 1,200 tons per day. We'll say that the processing costs are about $25 per ton. You can also incorporate transportation and smelting costs in terms of dollars per ton concentrate if we want to. We'll say it costs $90 a ton to haul what little concentrates there will be with this type of project. And a relatively high concentration ratio, of course, let's say 1,200 tons ore per 1 ton of concentrate. From here on out, it's program begins to do the type of work that is not easy to do on a spreadsheet. We'll have the program deal with the commodity, smelting, and refining data here. So it'll incorporate all those charges into the analyses. The next couple screens will deal with financing and royalty and joint venture calculations, which again are a little more complicated on a spreadsheet, but the program does them automatically, and then the tax information. But let's start with the smelting and refinery. Essentially, we're going to define the commodity values on this screen. So, in other words, what we get paid for what we're producing. Say gold is selling for $1,600 a troy ounce right now. Silver for $28 a troy ounce. Say we recover 85% of the gold through the mill and about 65% of the silver. When we send this to the refinery, they'll pay us for 98% of the gold we send and 92% of the silver we send. There's no smelting, so we don't have any fees there. The refining cost will be about $1.40 per troy ounce gold and 65 cents per troy ounce silver. All the values on this screen, by the way, are right out of Mining Cost Service. Capital costs are handled in the program in more of a free field type entry situation. So let's say for mine equipment, we'll purchase $20 million worth of mine equipment in the first year. We have a variety of tax treatment methods available. Modified accelerated cost recovery system, which is the current preferred method in the U.S. Straight line, double declining balance, diminishing balance, sum of years, digits, straight amortization. You can see all the methods available. Most of these variations of these are used worldwide, so the program can be used in a variety of countries. In this case, we'll treat our mine equipment as using a MACRS approach. Again, the help screen will give us some information as to depreciation periods. Mining machinery has a 7-year depreciation period, which we'll enter. And then we'll add that to our analyses. Let's enter some processing equipment. $9 million of that. That will be purchased in the second year of our project. Again, it's an MACRS treatment method, tax treatment method with a 7-year depreciation period. We'll add that to our analysis. We'll add some development costs in year 2. And development is treated in U.S. tax codes with the 70% expense and then 30% amortized over the next 60 months. We'll add that to our analysis, and let's put in some reclamation cost. At the end of our project, year 9, we'll treat those as reclamation costs and add that into the analysis. You can see the program can also handle loan scenarios in the assessment, conventional and commodity loans, then the specifics of which can be defined in the following cells there. Can also look at joint ventures and the definitions of those agreements are specified through these cells. Royalties are also available in the program. You can define net smelter return royalties, production royalties, federal royalties in these cells here. And advanced fixed royalties can be defined and entered into the analyses through these cells. And then taxes, of course. Federal income, state income, provincial income, taxes. You can see what's available. As I say, these are mostly based on US, but can be adjusted to reflect tax considerations almost worldwide. Escalation can be entered here if you want to include escalation in your analysis. Labor, supplies, and equipment costs can be escalated separately or as one unit, one group, and as a general cost. Should go back here and point out that prices can also be escalated separately here. So with the information we've entered, we already have some results. Our project has a net sum of cash flows of about 40 million, 6 million NPV at a 15% discount rate, payback period of 2.9 years, and an internal rate of return of about 20%. Look at the cash flow schedule real quickly here. And so revenue is up across the top. Operating costs here, then of course all the considerations all the way down through the project as far as tax treatments, capital treatments, tax calculations, adding back in all those considerations for the tax calculations, and then the after-tax cash flows here, the net cash flows there, and then the cumulative across the bottom for the entire project life. Program is rather powerful in the analyses that it can do, so let's tag some variables for analysis. Let's look at the gold price. We'll adjust the wall rock gold grade, the gold grade and the wall rock grade for gold. We'll say that varies dependently with the gold grade. We'll include the operating cost for mining as an independent variable. We'll also take the gold price and independently vary that. And let's take a look at our development cost as well and tag that for analyses. So let's go up to the parameter screen, and here's where we define the type of analyses we want to do. we'll look at several things. We'll look at sensitivity and break even. But one thing we also want to look at is a Monte Carlo risk type assessment. And so we'll say all four of the things we tagged will vary through certain ranges over the course of the project. The first thing we have is the gold grade. Let's say we believe, through our own analyses, that will vary from minus 25%, 0.0525 ounce per ton, to about 0.805 ounce per ton. And that might be the range of our sampling. But let's say we do have an average grade, so we'll skew that distribution so this 0.7 is the most likely result we'll get. Do something similar with the mining cost. We'll say it varies from, through our estimate, we won't be any cheaper than $30 per ton, but it shouldn't cost us more than $44 a ton. But again, our most likely value is the $40 per ton, so we'll skew that analysis, skew that distribution as well. Something similar with the price of gold. Be a little optimistic and say it won't go below $1,360 an ounce, but it might be as high as $2,000 an ounce. We'll say today's value is the most likely value. And for our development cost, we'll say that it may be as low as $9 million, but shouldn't go any higher than $12.6 million. We'll skew that analysis, or skew that distribution as well. When we do a Monte Carlo risk assessment, we'll go ahead and have it do 5,000 iterations. Let's look at a couple things here. Let's do some break-even analyses. First thing the program's looking at is the first thing we tagged, which is the gold grade. It starts in by doing analyses without using the discount rate, but we'll of course want to throw the discount rate in. So our project should be profitable at a gold grade of above 0.065 ounce per ton. Let's do the same thing with the operating costs for mining the ore. We still should be making money at a 15% discount rate at an operating cost of $46 per ton. Price of gold can go as low as $14,883, excuse me, and we still should be able to make money at a 15% discount rate. Sensitivity analyses, of course, are available in the program, so we're varying our gold grade between 0.0525 and 0.0805 ounce per ton. You can see the various sum of cash flows, net present values, payback periods, and internal rate of returns. Project's fairly sensitive to the grade of gold, going from losing money to about a 29% return on investment. Not so much for the mining cost, going from a 16.7% rate of return to 27% rate of returns through the range we defined. Not quite as sensitive either to the price of gold, making money all the way through $1,360 to $2,000 per ounce. And our development cost has very little impact on the overall project net present value. Let's look at the risk assessment. So the program will go through 5,000 iterations, varying everything we tagged independently and randomly throughout 5,000 different analyses. Doesn't take too long. You can see the mean net present value of about $7 million, $7.5 million. The lowest it goes is a -9, highest is 29 million. Again, this is varying each of these items randomly and independently over the distributions we defined through 5,000 separate analyses and then accumulating the results. Let's view a little bit of the statistical analyses. The data is presented here. Of course, these things are best looked at graphically, and we can see that given the variations we defined and the costs, production, and revenue data we entered, we have a 85 to 90% degree of probability that we'll have a profitable operation here. We've already looked at the cash flow schedule. Also available is a value and cost schedule, which will give you the gold and silver values after everything's been considered, such as recovery, smelter payment, or refinery payment, and all those items, along with the costs. So as far as gross value goes, we're getting $106 per ton of value. It's costing us $65.64 to recover that. Capital deductions are also, we didn't enter very many values there, but the way these are viewed over time for tax calculations are listed here. So our double declining balance with switchover depreciation schedules are there. The development schedule was 75% expensed first year, and then the remaining amortized over a 60-month period there. Let's see, our reclamation costs occur in the last year there. And that's about it. You can, of course, save things to files, open file, or, of course, draw back projects you've entered previously. There are several print options available. You can print different reports. And, of course, you can print to a file as well, which can be then drawn into a spreadsheet. And so that's a quick demonstration of Apex for Windows, our economic evaluation package.